A partial US-China trade deal has been signed, but it would take long, protracted negotiations for a full deal to materialize, if at all. Meanwhile, the ongoing tariffs that remain continue to weigh on economic growth across the region. Slower economic growth in China will also spill over to the Asia-Pacific region. Some markets, such as Vietnam, South Korea and Taiwan, are, however, benefiting from the trade diversion away from China.
2019 has seen quite a dip in GDP growth globally. We expect that to be relatively stable into 2020, going just a touch down to 2.5%. We expect China GDP to continue to slow.
Many economies in the Asia-Pacific rely heavily on trade with China. And the banks that are exposed to various export-related industries could be hurt by weaker demand from China.
We've got trade tensions and slowing GDP, which is likely to put pressure on the bank's asset quality and therefore profitability. We see the small banks as vulnerable in China and potential contagion risks across the sector. On top of that, we see an overall sector capital level that's not quite adequate enough.
Singapore banks are already making some provisions for a challenging year ahead.
So if you take third quarter, for instance, both OCBC, UOB and including also DBS, all three took general provisions to cover for things like Hong Kong. And we are still looking at a slower growth environment. We're still having all these challenges of trade war, China slowing down. So it is only a matter of time before you start to see some asset quality deterioration.
Overall, Fitch's banking sector outlook for markets in the Asia-Pacific is mixed. Developed markets are seen as stable despite some headwinds. Some emerging markets are seen as negative.
Singapore, Hong Kong, Japan, and within them they all have similar headwinds. So they have headwinds on falling interest rates, increasing competition, lower growth. On the emerging side, we've got a negative outlook on China, Indonesia and India.
Another ratings agency, Moody's, sees moderate increases in problem loans for Asia-Pacific banks, especially in the corporate segment, which is increasingly over-leveraged.
Our outlook for this year for banks in Asia is negative. We think that the fundamental credit conditions will weaken modestly for banks in Asia. And the prime reasons for that weakening would be, slower economic growth in Asia. A lot of it is driven by trade challenges, the trade war that's still ongoing between the US and China. On top of that, we have interest rates in Asia that are decreasing, and that is putting pressure on bank net interest margins.
We expect rate cuts in China, India and Indonesia, and on the developed side we expect Australia to cut rates again and a small cut in Korea. So there are positive and negative impacts of the interest rate falls. The positive could be on the general growth outlook. The negative would be that it overall net will impact banks' profitability somewhat.
We probably may see some rate cuts in some economies. It means net interest margins of the banks will continue to decrease, meaning that banks would make less revenues from lending. What it means is that banks would probably refocus their efforts on growing the non-interest income of their P&L, meaning fees, trading, wealth advisory, sort of those earning streams that are less dependent on net interest margins. Again, in the Singapore context, the Singapore banks are doing just fine. I think their non-interest income part of earnings is about 30 to 40% of the total pie. That's a good outcome.
According to Maybank, Singapore banks offer defensible income and some of the highest dividend yields globally.
We are actually positive on the banks. One of the key sort of areas that we are looking at is how defensible are dividend yields. We don't know all the surprises that 2020 will hold for us. So as if I'm an investor, one of the things that I will be looking at is, as I go in, and I don't know the entire situation of 2020, how can I be defensive and position myself defensively? So I think from that point of view, the Singapore banks offer some of the highest dividend yields amongst the regional banks, close to 5%. They have this potential to surprise on the upside, especially if interest rates remain flat. Most of the street, and along with us, we are actually looking at interest rates continuing to fall. If that doesn't happen, margins will actually surprise on the upside as well.
Singapore banks will announce full-year earnings next month. So amid increased uncertainty in the regional macro environment and potential for rising non-performing loans, how should investors be positioned?
Our top pick is UOB. We have a buy on this stock, and the primary reason is if you look at the historical sort of performance, one of the key things that we see is very conservative balance sheet management. If you look at historically as well, their non-performing loans increase, the volatility of that is a lot lower than the other two banks. We also like DBS from a more shorter term standpoint, and mostly of that is driven by the fact that they've got strong margin growth over the last year or so. They've got very strong capital levels well above where the regulatory minimums are and where the management's upper sort of safety limits are. We are hold on OCBC. We're a little bit more cautious on credit charges, especially given the sort of exposure in North Asia.